Welcome to the Friday night live stream. I just want to take the opportunity and, we'll wish everybody a happy Valentine's Day. I'm obviously on loaner this evening for a couple of hours. You can tell how sincere I am about delivering this message every Friday. 2 hours is not that much time to come on and say my piece. It's an infinite topic, and I just enjoy the heck out of using the YouTube opportunity to reach out and reach as many folks as I possibly can. If it's your first time to the Independent Investor Channel live stream, this is not an entertainment channel. I'm not really trying to be a social media superstar. As a matter of fact, there's a lot about social media I despise, to be honest with you. It's rather shallow, to be quite honest with you. Some of the best investments that I've ever made in my life have nothing to do with stock. Or savings or budget or any of that. It has to do with the folks that I'm actually taking time away from this evening. But I do want to thank you guys for making your way on here. It is important. It's super important. The clock really is ticking. It's ticking for everybody. All right. The question is, how are you going to use the time that you're allotted? Okay. So if you're a 20-year-old investor, you're making your way onto my message for the first time, stick around. It's life-changing. Okay. I'll probably limit the Tesla discussion to as little as I possibly can. I'll probably keep the cannabis discussion even less than that. Okay. I know there's a lot of different YouTube channels out there. Lovely. A lot of different philosophies and style. But at the end of the day, you really need to ask yourself a couple questions. Is this investing thing for you? Okay. I just had a great discussion with one of my friends on the West Coast. He reached out to me through the channel. I enjoy that, so I will float that olive branch. I've done that in the past. For those of you who just want to reach out to me directly, honestly, a live stream forum is not necessarily the best forum to do that. I'd be obliged to vet that request. Let me know a little bit about yourself. It helps streamline the discussion a little bit. And there's some folks in here that I've done that for already through the history of the channel. I enjoy the heck out of it. It really speaks to the reason why I'm trying to leverage this opportunity and speak to as many people as I can. I had a discussion with a colleague this week at work, and it took me all of 2 hours to explain that you can actually liquidate a holding within a Roth IRA. So you can see how this topic can be confusing to a lot of people. All right. And I was born with a gift, an affinity for finances. Obviously, it's not one of those topics that you can know it all. It's really not. But I can say, rest assured, that I was never destined to be a lead singer or a guitar player in a band. That's for sure, even though I do try. I'm good at this gig. I really am. And a lot of what makes sense to me, I'm really trying to scale for myself. Been pretty successful at rolling out this program that I work. Made a lot of mistakes as well. And that's why I contend there's, about 400 videos in the catalog of the Independent Investor Channel. And if you've paid close attention, if you've paid close attention to the message that I've put through, sometimes I feel like the easiest but the most difficult thing to do is initiate a program and stick with the program. Really is. And it comes back to my time frame analogy. If you're 20 years old or you're 55 years old and you're looking at a 55-year-old program and you're looking at it and you're coming to the channel for the first time and you're saying, gosh, is investing for me? And the answer is absolutely, as long as you do it right. Okay, there's a lot of people out there that are going to seek out the investing opportunity and render a lot of different results. Okay, and that was the theme for the videos this week, and rolling out and really pressing a little bit more on the Vanguard opportunity. Okay, because I just have one voice. I really do. And I feel for every one voice out there like mine, there's 100 other voices talking about Tesla, 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 and trying to feed the search algorithms to give people what they want. And that is, should I buy Tesla now? I really have to question the integrity and the downright discipline, honestly, if that's really what people are looking to seek out in their opportunity. If they feel like just because Tesla's all over the news that it's a buy here at $800. Let me tell you about my Tesla experience. I hold Tesla now in my aggressive growth. I'm up 100% in the shares. Um, it's almost as if I've made money and I really don't want to make money because I want to sell the stock now. Now I'm stuck in a taxable situation. So what are you going to do? Are you going to take a risky position like a Tesla and put it into your retirement account? I think not. You have to be really, really careful. And so many people out there want to look at investing and they want to ignore everything that's important in investing with regard to your own psychology and your own capability and your own budget and your own inflows and your own tolerance and your own ability to actually have dollars put to risk in the stock market. And by failing to do that, you always want to look at the end game. What's the perfect stock? What are the 3 stocks to buy? I'm guilty of it too, right? I'd like to build my channel for the sheer reason of getting to as many people as I possibly can. But everybody wants to know what that perfect stock is to buy. Everybody. And I really feel like it's a catch-22 in the answer. I always come back with, well, it depends. It depends on a lot of different things. What is it? What is it that you want out of investing? Why invest in Tesla? Why invest in Johnson and Johnson? Why seek out a stock with a 10% dividend yield as opposed to a 5% or a 3% dividend yield? It's a rhetorical question that I throw out there. And I'm quite certain that you guys are all going through, and the folks that are making their way onto YouTube to get their sound financial advice have answered those questions for themselves. However, for the folks out there that have failed to answer those questions, I encourage you to do so. All right. Ask some questions about yourself, what you want out of investing, why do it. And if you are that 20-year-old or that 55-year-old and you've got a 10-year time horizon or you've got a 40-year time horizon, make sure that you're filling up that 40-year time horizon or that 10-year time horizon and as well as you can to maximize your opportunity and minimize your risk. That's about as cutting edge as I can put it. So for you guys within the first 10 minutes, you've basically been provided the essence of investing. Okay. I understand it's not the sexiest thing out there to sit across from a YouTube creator and hear, but it's the truth. Now, it's not the truth for everybody. There's a lot of folks out there that can gain success utilizing a lot of different strategies in the market. Okay. And now we start to introduce a lot of different methods of making money. Swing trading, penny stock investing, which is something that I don't advocate, but there's people out there that make money. But the reality is that very few make money doing it. Okay. Very few people quit their day job to become a stock trader. Okay. And the question becomes, do I need to find that next best thing? Colleague came up to me and said, you need to look into Rex Technology, okay? WRTX, I believe, is the ticker symbol. Sounds very intriguing. It kind of goes along the Taser opportunity that was about 20 years ago. You guys all remember when Taser came out. But this was an interesting stock in that it's a personal restraint device that you actually shoot at an assailant and it wraps them up. Okay. It's a $6 stock, $7 right now. If you guys want to go check it out, WRTX. And I thought, of all the times in my investing career that somebody's had the next best thing for me that I've invested in, I typically end up losing on that. And I've always chalked that up as speculation at best. All right. So you've got penny stock investing, you've got swing trading, you've got speculation, you've got dividend growth investing, you have passive investing, you have 401k investing, you have cash on hand. All right. So you've got all these different avenues. What we try to do for the masses, okay, those investors that, in my assessment, are extremely self-deprecating, okay? I can't tell you how many people I talk to in my community that are just like, I'm stupid. I don't know what I'm doing. I'm stupid. I don't know what I'm doing. I bought this VOO. Now I don't know what else to buy. Calm down. Okay. First of all, you're not stupid. All right. I've got cash on the side. You know, it's not working for me. Well, hold on a second. It has to do with your perspective about what you're looking to get out of that savings that's on the side, right? I have a lot of cash on the side. I don't look at it like I'm missing out on anything, not in the least. Okay. So it really kind of comes down to your perspective, but I really want you guys to take away and think about what I said about if you're one of those folks in your early 20s and you're one of those folks in your 50s, think about how you can maximize your potential with minimizing your downside risk. Super, super key. And you're going to ask me, okay, well, Ryan, what do we do to do that? Okay, we have solutions to do that. What amazes me is when I turn on CNBC, and it's amazing how many people are not as advanced in our discussion with regard to self-directed investing than this fine community right here. All right. So feel good about it. I really think that this conversation escapes. I guess Charles Schwab admitted today of investing in WeWork. That was really interesting. Said it was a terrible investment. Well, no kidding. No kidding. Like, what analyst made that determination? What were they looking at to determine that that was a good investment? I think it was in their mid-cap fund, but they had to come out today and apologize. They lost every dollar they invested in the company. Furthermore, I think there's still a stigma or an understanding that money managers are like God. Okay, they are not. Okay, they will do everything that they can do to hide from the inability to at least meet the market. And so you have pundits on TV all the time that will come on and they can regurgitate the Wall Street Journal better than anybody because they have photographic minds and they can read an article and they can regurgitate it on TV as if it's gospel. The real talk right now is your ability through technology to actually seek out your exposure at a very, very high level, free. Free. Okay. So when you're asking me, okay, Ryan, this all sounds great. I'd love to get invested for the first time, but I'm an idiot. Okay. But I hear you talking about these ETFs, index funds, mutual funds, if that's your thing. Okay. I really contend that mutual funds are kind of a thing of the past. I really do, because you are introducing a money manager that is overseeing that money and they're taking strategic moves to gain in that particular fund. My question is, how much more risk, remember the time horizon, how much more risk is being taken on so they can maybe outperform the market a couple bits so they can advertise heavy at the end of the year that they're a fund that beats the market, one of very few, right? Okay. On the other hand, if you're one of those investors that just decide to buy a passive investment opportunity, how much risk is involved with that diversified product as opposed to paying a money manager and a high expense ratio on the mutual fund side, right? To take the risk to get you that 2 points of extra appreciation. Okay. Some things to think about. I want to give an opportunity. I want to shout out Jerry with GW Life. I hope he's in the group tonight. If he's not, I caught a video of his this week that I thought was really quite good. He was comparing the S&P returns to single stock. I think he used a 5-year time horizon. I thought it was good. I think the longer time that goes along, I think that certain single stocks can blow away the market returns. But in this example, he put a 5-year time horizon on it. And I think he compared like IBM, Wells Fargo, a couple other names there, and basically determined that over a 5-year period, those did just eke out what you would have been returned in, let's say, SPY or IVV or VOO, okay, which is the S&P 500. And it was an interesting comparison. He was basically saying, is it worth it? Do you have the stomach to hold these stocks because they can underperform the market for years at a time? And then finally, it can do what Apple did last year. And boom, look at it now. It's up close to 90%, right? So it's made up those gains of slight underperformance or heavy underperformance. So do you have the stomach to look at your portfolio, and is that acceptable to you over multiple years for the chance of actually seeking out that alpha in your portfolio? And I thought it was a really, really good video. I was hoping that he would say a couple things, that of which I'll augment the video with this. I really think that when you do that cross comparison over 5 or 10 or 25 years, whatever it is, they're always interesting to look at. And it can validate your program as well if you're looking at, entering into the single stock game and what it entails. But one thing interesting that I wanted him to say, and I kept thinking when he kept doing the comparison, was thinking about the risk or the systemic risk in the single stock as opposed to just buying the market. Now, buying the market for 5 years, you're going to buy into it 5 years ago. You're going to forget about it, maybe fund it, yes, and let it grow, okay? But a company like Wells Fargo, for example, and you're going through an account scandal that it went through, and all the other accounting garbage that they had to go through. And they're not the only one, okay? I've been guilty of this in my past. Some of the worst trades that I've had investing in General Electric for things that I could have never found in a balance sheet, ever. I mean, what they were doing behind the scenes were never, ever disclosed in the balance sheet. So those types of things, you can do all of the fundamental research that you can. You can have a good technical setup on the charts, and it can still bite you because you're giving that stock 5 years to do what it is that it's going to do, okay? And rest assured, that stock is probably going to be pretty volatile over that time, and it really requires a higher level of risk tolerance for a lot of investors out there seeking that type of exposure to the stock market. Is it wrong? No, it's not. It's one of the most prudent ways of seeking investment exposure. But you really have to be honest with yourself with regard to your self-assessment and asking yourself, is this for me? And I've had a ton of validation come through the channel thanking me for at least pointing out from one perspective. I'm a small fish in a big pond, okay? But we are trying to empower a community of individual investors, okay? I'm not trying to have a portfolio contest on YouTube. I'm not trying to do that. I could care less, okay? The size of your portfolio or the size of your YouTube channel means absolutely nothing to me, okay? What means something to me is if by nature of review of that large portfolio or by nature of you reaching a large audience, you're making an impact on people, now we'll talk, okay? Now we'll talk. But here's the thing. If you're being misled in a program that may work for other people, but it just isn't in line with your values or your risk tolerance or your investing strategy, then I've got news for you. It's not for you. Let it go. Let it go, okay? Because you will continually evolve as a stock market investor for your entire life. You will. You're never, ever going to have this thing completely licked, okay? There's nobody that can ever come on and tell you to invest one way, and that's going to be the style that's going to allow you to ride off into the sunset with financial riches. It just doesn't work that way. As a matter of fact, I have a little bit more cynical approach to the stock market, that of which a lot of people have actually kind of forgotten over the last 10 years in really understanding how much turmoil this market can really dole out, all right? So when the number one searched question through Google Analytics is Tesla a buy? Ask yourself, Are you really that curious about it? Because I, for one, am not. I could care less. And I'm up 100% in the stock, and I'm really kind of upset because I want to sell the stock, but I just finished up my taxes this week, and I was able to remind myself how important it is to tax protect from the government. Because if one thing is for certain that I've been able to notice over the course of my life through different administrations, I sensed the difference through the Bush administration. I sensed the difference in my pay through the Obama administration. I sensed the difference through the Trump era. Okay. And as a working class fella, to be honest with you, nobody's ever given me a handout, ever, ever. I pay into the system more than I get, but I did take some liquidations last year that I had to claim. And the $2,000 that I rendered, $2,600 in renderings, actually put me on the hook for $600 profit. And my wife heard that and she was like, "Why do you get to pay that money?" Yeah, that's how it works on the short-term capital gain side of the house. This is why the flip side of the coin is, I know we focus on the products because that's what everybody's interested in, but there are solutions with regard to product. But I always want you to think holistically about your program, your account, okay? Because the majority of people out there have no idea the difference between a managed and a self-directed account. Most people have no idea. Up till 7 years ago, I was one of those. Okay. So if nothing else, sharing that particular aspect of the niche on this channel is super important to take away. If you don't like me, no problem. Okay. I can be brash. I don't have that likable personality. I don't have charisma. Okay. I won't apologize either because I'm the same old fella when I'm away from YouTube. And that's why really the people that I'm looking to appeal to are the ones that respect me the most, because they know that I'm a straight shooter and they know that the stuff that I talk about, I put real dollars to work in. Okay. All right. So with that, guys, I would love to engage in a discussion. I obviously open up these live streams to be a collaboration. I've dropped the invitation in the thread here, but I'll run the thing myself because I'm absolutely fired up today. And I only have 2 hours, and it's usually the quickest 2 hours of my week. So I'm going to throw the invite in there. If you guys have been kind of waiting, this is your opportunity. I'm going to hit it now. There it is. There's your invitation. Unique perspective. And I don't mean to come across like I'm a know-it-all, this and that, but this stuff really makes sense to me. My program makes sense to me, and I've been misguided as well. And I'd love to see more investors get on the right track earlier on in life. I'm sure a lot of the folks in the community that are in their 50s and 60s and 70s and beyond would agree with me. If nothing else, we can give back to some of the younger generation for the very, very few that are willing to accept the information, okay? Because it's super easy to get sidetracked. But with that, guys, I'm going to cruise over the comments and start to cover. I've got a ton of channel creators in here. Obviously, I like to do my shout outs, but I wanted to give Jerry his ample time for a video that I thought was super enjoyable. So hopefully Jerry can catch this after the fact. But I'm going to cruise up here. Individual investing is freedom investing. We all can get ideas from each other and learn together. Ryan really cares. Live stream works. Yeah, totally. I just, it was interesting watching that video. I paid attention to the charts, for example, the Wells Fargo chart and the SPY. And the Wells Fargo chart really did kind of come back, but it went through a very heavy swoon for a while. So it just speaks to my point about making sure that you're okay with the volatility, because if you're, it's hard to look at the market now. Last year rendered close to 30%, right? So if you're an individual stock investor and you can't come back to me and say that you just invest in stock for the dividend, that's not good enough for me. I'm sorry. You're not going to get my blessing. I'm not going to say that you're the greatest investor of all time, but if your goal is to seek out yield, congratulations, that's what you're going to do. Just be careful that you don't go into hawk on a position that you have 10 grand in, okay? Because you've sought out a higher than average yield, okay? Just saying. All right. This is business. This is not emotion. You don't have to get mad at me. All right. If it'll make you feel better, you can shoot holes in my portfolio, which there are many. Okay. But never hurts to be critical over some of the programs for the sheer intent of making sure that we are aligning the proper strategy with the right investor. That's what we're always trying to do. And you can succeed with either one. You really can. The upside potential with the single stock is much higher. The risk versus the reward has to always be weighed. So the question is, do you have that fortitude to watch your money be subject to that higher volatility in single stock investing? And a lot of you guys are going to say, well, it's dividend investing, Ryan. I don't have anything to worry about. BS. Okay. I don't agree with that either. I'm sorry, again, if it's just my opinion, but single stock is single stock. Okay. And if you guys think that I was the only one in the world that got caught up in the Kraft Heinz food stock or the General Electric saga, I wasn't. Okay. You have to have a short memory on the stock market. I get it. But these dividend stocks, they go into swoons of volatility as well. So the idea on that strategy is to make sure that you're catching that uptrend of dividend increases over time, lowering your cost basis, all the good things that do require a lot of homework to understand why you're accepting that, number one, volatility, number two, risk by entering into a single stock without the complement of diversification, right? And seeking it for that higher than average yield. And I come back to this all the time, guys. I'm going to say something that is really going to stick and resonate with you. I hope that it does. I'm going to say it now, okay? The S&P 500 renders a 1.9% dividend yield. Pretty anemic, right? It's nothing, right? Well, it's not nothing, okay? It's something. It's close to 2%. The VYM, the video that I just released last night, renders over 3%, 3.19 to be exact. Okay. So if you're opting for the single stock option and the dividend yield that may be higher than average, okay, it needs to perform at a clip that is going to surpass what that ETF is able to render every year at 7.5%. That's it. Okay. And you might think, oh, I can kill 7.5%. Yeah, that's your ego talking. Okay. Show me that you can do that consistently. Okay. See, here's the thing. All the Tesla investors right now, right? The $500,000 portfolios with 12 stocks. These things are just leading people astray right now. They are. They're doing more damage than they are good. Okay. They're doing more damage than they are good. And for the people that make their way onto the independent investor channel, they don't need to take what I say as gospel. They don't. Okay. I'm just another fellow investor with my own unique strategy. Okay. But I may be wrong. Okay. But entertain the possibility that I'm freaking right. Okay. That's the scary part. The latter is the scary part. And if I'm right, there's a lot of people that are going to have a rude awakening. It's going to be rude. And I wish we could save them all, but I know that's not the case. All right. I really do. The stock market is not a game. It has to be taken very, very seriously. It's not something that I can come on and whistle dippity doo dah and put a cowboy hat on for you guys and entertain you while I'm making a ton of money in the stock market. That is not the respect that needs to be paid to the stock market. It's not. It needs to be leveraged. All right. And it needs to be used in a manner that understands that if you took your entire investment account and it was gone tomorrow, how would you feel about it? Scary question, right? Have you ever thought about it? No? How about this? How about if you woke up on Monday and the pandemic had spread, okay, and the stock market gave up 40%? How would you feel about that? Would you lose sleep over it? Would you reassess your risk tolerance, or are you good with it? Did you already go through those deliberations before those systemic risks were able to take hold on what can be a very, very violent place? And when it becomes violent, everybody comes and piles on to the same rhetoric. Right now, nobody has any negative to say about the stock market. Well, I guess the consumer is strong. Well, I guess the market does have a lot of room to run. Okay. All right. That lends itself credible to the investing for the long term, right? Staying invested, that type of thing. But ask yourself, is this really a market that you want to be playing with right now? And if you're seeking exposure with 12 stocks, and that's the majority of your net worth, you're crazy. Okay. And the interesting part about it is, since we're being critical of programs tonight, right? I thought I'd have a little fun. I look at an investor like a Gen X dividend investor, and I chronicled most of his videos. That's a situation that works. It just works. That's why I give such high kudos to that investor, because it is air apparent when you watch that video that his program is suitable for that style of investing. Okay. Now, what I fear is hundreds and hundreds, maybe thousands or 10,000s eventually will watch that and be like, I want that. And they're not willing to go through the level of deliberation that a Gen X dividend investor has gone through, right, to render that type of portfolio. Now, there's a difference between that level of security and that dividend portfolio as opposed to the $500,000 portfolio that I'm talking about. Okay. 12 stocks, heavily weighted to certain names, no real diversification to speak about. See, Gen X's portfolio is diversified across the sectors. He's basically just cherry picked the best names out of the sectors, and he has representation across all of them. It's legit. But very few people can stomach, if I gave a new investor that portfolio, you'd freak out and you'd be able to handle the swings less than 6 months. I'd give you 6 months, you'd screw it up. Okay. So what do? You have to be able to and be willing to go through the deliberation of building your portfolio. You have to build it. Building wealth. I don't even like to say investing in the stock market. It turns most people off. But if you say building wealth, that's interesting. What do you have to say? So it opens up the envelope to all the other discussion about how we go about building wealth. Tell me more, Ryan. Really? I have 20 years. Does that matter? Should I be asking those questions? What do you want with that money? What other investments do you have in place that are going to help supplement that building wealth program now? 401k, right? Cash savings, debt consolidation, those types of things, right? Am I fit? Am I fit to enter into the stock market at this point? These are all great questions to ask yourself. How much time do you have? What's your tolerance to the market? Are you even open to single stock? Because that's a real diverging path for a lot of investors, honestly, that are looking to get through that deliberation. And they're like, yep, I get it. I want it. Boom, I'm done. Debt, good. 401k, done. Matching, done. I'm good, Ryan. I've got this set up on I want a dollar cost average, or maybe even, hey, you've mentioned the strategic opportunity, this VYM that you covered. You said you're making over 7% a year in this. Sounds pretty interesting. Does that include the dividend? No, it doesn't. Okay. Does that include dollar cost averaging? No, it doesn't. Okay. That's just assuming on X number of dollars that you're getting 7.5% performance on that money, right? So if you put that good product into a tax deferred vehicle like a Roth IRA, you can monitor that holding with the intent of never selling it and then buying every time it goes down. Strategic buying. I'm the only one that talks about it. It's really not that difficult. I'm not a genius. I'm just a regular guy, but it's an interesting strategy that I've deployed over the 25 years that I've been investing, and it's making me rich. Okay. And it's a very, very simple strategy, that of which I'm not charging you anything to come and be part of this community and be like, wow, that is a good idea. All I have to do now, I'm dumb, right? I don't know anything about the stock market, but I know enough to understand that, wow, this is pretty cool. Ryan showed me the way to get onto this Vanguard website and maybe look behind the curtain and see that it's representative of 400 companies. This is awesome. It renders 3% yield. That's pretty awesome. I can set this up on a drip. Yes, you can. You can have those dividends accumulate and roll back into the stock. I can monitor that fund, okay? And if we do get a hiccup in this market, I'm going to take advantage of it. I'm not going to panic out of the market. So I didn't get to mention at the top of the stream, I'm pretty sick. So I'm fighting through this live stream. So if anybody wants to come in and help me, otherwise I'm going to go for 2 hours on my own. But I'm feeling pretty under the weather. No coffee tonight, actually. Look at those eyes. Oh, my goodness. It's green tea tonight, guys. Some chai tea. I hope everybody's doing great, man. I'm going to get to some of these. VYM is SHIT. That's awesome. I'm not really sure I understand. If you want to give me a little bit more to understand that, that'd be great. Certainly, if you're willing to focus on everything else that I just talked about in the top of the 10 minutes of the stream, Tesla, weed, outperformance, all the stuff that is super difficult, almost a pipe dream, okay? And I know people are going to say, well, I know tons of people that are outperforming the market. No, you don't. No, you don't. No, you don't. Not, you don't. You don't. I smell it, okay? You don't. It's arrogance talking, okay? And arrogance sells, absolutely. You get on and pump a bunch of arrogance through YouTube. Certainly, it sells because you're very persuasive, right? But VYM is certainly not a poor ETF to invest in. Can absolutely align with a lot of people's goals. I'm not saying it's for everybody, but it's one of those things to where if you're one of those seasoned investors like myself, I tend to spend a lot more time focusing on the year-over-year performance at 7 to 10%, which will absolutely fuel compounding growth, which doesn't get talked about enough on YouTube, to be honest with you. And if you're going to fuel that compounding growth, that's the magic in investing. That's a reason to invest, right? So if your focus is on everything else, right, catching a wave in Tesla, maybe you invest in it here at 800 and it goes to 5,000 a share. That's awesome. I'll be the first to say, hey, great speculation trade. That's rocking. But I won't give you credit for being an investor. Forget it. It's in a different category, bruh. That's just the way of it. And sorry if my deliberation is contrary to some of the other messages on YouTube. It is, and that's great. And like I said at the top of the stream, I'm a small fish in a big pond. So to each his own with their investing style. I think a lot of folks in this community, they get it. They really do. And if a VYM isn't for you and an S&P 500 isn't for you, okay, perhaps maybe a single stock option is. Maybe an aggressive portfolio is, okay? Roll out the update. I'm up $1,000 in the $5,000 portfolio. I've owned it just over a month, okay? And that just goes to show that's 2.5% of my total investable portfolio, not even my total portfolio value. 2.5% I have in 12 names. So comparatively speaking, having all of my net worth, $500,000 wrapped up in 12 growth stocks is asinine. You want to gamble? Gamble. If you want to gamble, gamble. If you want to become an investor, then become an investor, okay? And there's very few ways of doing it, and they're the easiest ways to pursue. They really are. They're for those investors, man, that are everyday workers. They may have a little bit to parlay from their check, right? $25, $50, $100. Those are the people I want to speak to, because if VYM is a poor product, right, what alternative would you suggest? I think investing is for everybody. I really do. And I think some of the faux pas or some of the hesitation from a lot of people shouldn't exist. The barriers to entry to the market. And that's what I typically look to exploit when I'm talking about the investing topic, is to exploit some of that garbage, because in my mind, it doesn't exist. Because again, some of these fruitcakes on TV that are talking like they know investing, they have no idea that these communities exist, man. They don't. They don't. And we're well ahead of the curve, okay? And if you're just hung up on the product, the flip side of the coin is don't lose track of the power of tax protection and having that in that Roth IRA tax free and free fee. It's so huge. You don't understand how big it is, right? Because so many people are opting for that management because they think that a money manager that they've never met is going to magically outperform the market for their time horizon. It's a pipe dream. It's a pipe dream. It's not going to happen. Remember when I said at the top of the stream, maximize your investing time frame. You want to know why? Want to know why? You don't get to do it again. You don't. You have one shot. So when you're reflecting back on your life and you're looking at your time horizon, do you want to be that person that looked at it at 20 and been like, wow, you know, I was really tempted to go and just kill it. You know, I could have been that investor. You know, Ryan, you're wrong. I don't know. I could have been that investor that sought out alpha, and I figured the market out. There's a few on YouTube who think that they have, honestly. Might as well just bless them, the stock god, right? I've heard this kicked around. I laugh because it's embarrassing, quite frankly, to people who call themselves a self-directed investor. And quite frankly, those are the people that professional money managers laugh at, because eventually they will get crushed. They will get crushed. All right. Good stuff. At the Financial Investor, Brent's with the channel for a long, long time, man. Really cool. Roth IRAs are great and probably number one tool used. Haha. Most people forget about the tax-free deferred HSA for sure. Exactly. There was a mention today about an additional $10,000 for low-income earners to be able to expose those dollars tax-free to the market. I just shook my head and was like, good grief, the Roth IRA is one of the most underutilized tools. The problem in this country is the freaking debt, right? That's why I'm very, very, very careful to talk about fitness. Are you fit to invest? Are you fit to subject your money to risk and go after that 7 to 10 rate of return when you're losing 29.9% on the credit cards that you've racked up, right? And it's okay. It's okay. I've been there too, okay? I've been in hawk with the IRS, which is even worse. Twice. There should be no reason, with the amount of mistakes that I've made, that I should be closing in on $500,000. No way. Not with my single income, okay? But if you just listen for 2 seconds, and this stuff will really, really it'll start to really, really make sense to you. It really will. Ryan, what percent of your net worth is individual stock? That's a good question. I did the stats last week. I'm sitting at about 72,000 total. $103,000 I disclosed last week was in passive investments, and about $133,000. I'm pulling these from memory. If I was going to give you just a quick number right off the cuff, I would say that the single stock exposure is probably around 30 to 40%. Okay. That's a rough estimate, but I bet it's pretty close. Okay. I've got a lot of cash and I've got a lot of passive. Those two portfolios that I ran this week in the M1 Finance, which is just a way of demonstrating information or displaying, okay, were for my spouse and for me. Those are the two passive baselines. So in my wife's account, there was two holdings, right? It was the VOO and the VBK, right? Yep. And in mine, there's 6, okay? There's the VYM, domestic dividend holders, VYMI, international dividend exposure, okay? Both of those are the dividend And I hold the S&P in my pension, in my TSP account, okay? So I think I mentioned that as to why I'm going for a little bit more dividend growth. It's fine. I fall into the low end of the spectrum. 7.9, I'll take it. With the higher than average dividend, I'll take it. I'm good, right? I'm good. The self-directed Roth IRA, man, it's awesome. Then I've got two specialty accounts, VPU and VNQ, okay, which is real estate and utilities sector specialty ETFs, respectively. And then I've got VBR in my account, which is the value small cap, okay, helps complement that. Then emerging markets and VEA, that's international exposure, international total market from Vanguard. Those are the six, okay? But hell of a good question. I wish I had a little bit better stats. I'd have to run it and do a little easy math real quick, but that is the full disclosure. Wandering Soul says that's the full disclosure. I'm stoked. I'm super stoked to be in cash right now. Obviously a pretty good chunk. I think it comes down to about $75,000 in single stock right now. Some of the best holdings: McDonald's I'm holding, Home Depot I'm holding, 3M I'm holding, Johnson & Johnson, Pfizer, Cisco. I did liquidate both Apple and Microsoft. Gen X dividend investor is going to throw a shoe at me. That's fine. That's totally fine. I'll live to fight another day. I'm still exposed to those stocks through the ETFs. That's totally fine. But those stocks have run up. They've run up heavy. And I think Microsoft has a lot more room to go. I think Apple is one crack away from a real downturn. And if it does, then I pick it up. If not, no big deal. I live to fight another day. I made a small fortune. I'm good. I'm not a pig. I am a bull. I'm not a bear, but I'm not a pig either. Okay. Jeez Louise, guys. You know, it's a loser thing if I sell Apple and take a pile of profit. No way. No way. I did it in my Roth IRA. No tax on that jazz. That's good stuff. I use M1 Finance and put $10 a day in Tesla, no matter the price. It does as I do the same with Amazon and Google. So awesome. Jim, that's exactly what I do. You guys know that I roll out that aggressive growth portfolio, the 12 holdings. That's exactly how I seek it out. They're all 11 out of 12 are up. I think Booking Holdings is the only one that's down right now, and it's killing it. It's absolutely killing it. So it just, you know, it's a relatively small amount when compared to the total overall. So I took a stab at it and look at it. And now I'm kind of irritated that I made money. And if you new investors are hearing me out here, you might like perk up a little bit and be like, God, this guy's irritated that he made money. Yeah, a little bit, because I understand the importance of tax protection. You see what I mean? Now I'm sitting on 100% profit in a stock I really shouldn't and can't sell. I can, but again, I just gave you the bad news from the tax this week that I rendered, that capital gains on the short-term side. So, you know, hey, that's the investing game. You know, there's a lot of different ways to make money. That's for sure. But, you know, hey, look, there's no perfect way of investing out there. You're not going to get me to come on and sit there and tell you my way is perfect. No way. What I do is I just tell you my way. That's it. That's it. And it's worked quite well. And we're going to get this thing honed in to exactly where I want it. I will be holding probably a 50-50 is what I'm working toward now. A lot of cash on the side, and then really holding just the core positions. I'm not screwing around. No garbage in the portfolio. These are the best of the best companies that I'm holding right now in accordance with my opinion. And that's what makes sense to me right now. And that's what we're doing. So good stuff. I hate missing the preaching sermon. Got another one to do. She's probably in the ER. Yep, she is. Thanks for coming on, though, for sure. So Rebecca had a great comment. Quest to Fire is an awesome freaking channel. And another, just working. She's a working class. She works. Her husband works, right? So the program fits really well. But I think they've worked really hard building a dividend portfolio, and I think that's lovely. And I suggested, hey, you've worked really hard to build that. You're going to be great if you're investing in quality companies, but you know, consider doing both. I do both, right? I'm not an advocate for one or the other. I have my preferences for new investors, absolutely. But for me, it makes sense for me to have a 50-50 split. I'm going to have 50% of the portfolio that's comprised of those cornerstone portfolios, which is a great way that I like to invest. And then the bulk of my holdings, the larger positions, right? And I can scale those positions, right? I'm not going to have a lot of my portfolio top weighted in 3M and then have a position in VOO that's $5,000, right? I'm going to have a big position in VOO and a big position in VYM. That's just the way I like to roll. Okay. And the smaller relative positions in some of those single stock holding, because I'm trying to buffer the risk to single stock ownership there. So super important. Treat finance is buy and hold forever. Pretty much. I chalk that up as the whole hardest and easiest investing advice that you could ever take. So good stuff. I got Ben from California, man. Awesome. California's representing another veteran. I love it, man. It's great to see you. Pretty cool. Sold early. 44 shares of Amazon. No, you didn't. You didn't sell early. You made money. Stop complaining. I know. You never can get it at a perfect bottom, and you can never get it at a perfect top. You know, that's a killer thumbnail, by the way. I love it. I won't stop till I reach it. Living a frugal lifestyle. Here's Phenom 1. Living a frugal lifestyle, paying yourself first in a tax sheltered account. It's not what you make, but what you keep, while saving harder and investing smarter. This is what I talk about with preserving wealth, okay? And the idea when I talk about maximizing that time frame, maximizing it, again, with the emphasis on lowering that downside risk, lowering and buffering that downside risk. The product that you do that in is an index fund, okay? You'll buffer that that downside risk, okay? Because here's the thing, your single stock gets cut, the dividend gets cut, get massive capital depreciation in the stock. It's going to look a hell of a lot less attractive to you. And you're going to have to do what? Sell at a loss or continue to hold or buy more? That's a scary proposition for a lot of investors out there, man. It really is. All right. The sacrifice for financial freedom, retire, gets me to like 1% of the time. It's good stuff. What did I just come back to? A man bear pig reference, South Park. I missed something in that rant. That was awesome. Yeah, no, hey, listen, I don't script any of my videos. I've got a couple talking points tonight, but I had a lot to get off my chest for sure. And it's all aimed at y'all's benefit, quite frankly. Like I said, I'm on lease tonight from my spouse. John Deere is a solid company. John Deere is a solid company. I put it up there with Caterpillar. I put it up there with Cummins, which is probably lesser of a tier because it's a little bit more specific. And I really like, industrials is actually one of my favorite. With UTX and Honeywell, those are a couple other companies that I really enjoy owning. There's a couple stocks that I'd really like to get. Gen X Dividend Investor. I know he threw it out there. He's doing portfolio reviews. I think that's phenomenal, man. I think that's really cool, but I could probably build about a 10 stock portfolio that I am interested to understand why he doesn't invest in it. Cisco being one that I would throw on the list there. But every now and then I'll come across a stock and be like, I wonder why Gen X doesn't invest in that stock. Visa is another one. Be curious to know. I actually sold Visa based on valuation here, but would have been curious to know, what his thoughts are on the payment space and fintech, etc., that type of thing. All aimed at furthering the discussion. But you bet John Deere is one of those solid companies. I owned Tesla long ago, almost 5 years now, and bought 200 solo around 300. Is that why your pie is so ugly? Your pie looks like a porcupine now. That's because you're a long-term investor with M1 Finance, Brent. That's super cool, man. Really cool. I'll take the opportunity, man. I'll throw another invite in the group here. Otherwise, I'm on a roll. I'm kind of like a diesel engine. So once I get started, I'll just keep going, honestly. But we'll remain on schedule tonight for sure. Honestly, I wish I could scroll to there was a heck of a good conversation in here. I want to thank Jared Odell for making his way in here. I was already passive investing, 75% of money with a 80% VOO and 20% in Europe. The rest I was buying individual dividend stocks. Yeah, it just makes you question. Here we are, we're trying to make it in a bull market, and passive investors are killing it right now. And you kind of question, hey, is a little bit more acceptable to kill it when it's good, accept it when it's not so good, fund it up, as opposed to try to piecemeal a portfolio over time. I think if you guys are honest with yourself, I really think you can come to the same conclusion as me, and that'll help you align your risk profile and strategy that you want to deploy. What is the results of the MF versus the ETF? Yeah, great. So retire with options, very good question. So I've done a lot of research on this topic, and it's a heck of a long-winded answer. I'll try to give you the short version. When you start to introduce expense ratio, which is the first real red flag in a mutual fund, okay, actively managed account, means that you've got a manager that's overseeing the fund, and it's built in any number of strategic ways to bundle it all up and put a bow on it and sell it to a customer, okay? Whether it be large cap growth, large cap value, whether it be, specific mutual funds, whether it be high growth mutual funds. Hell, they've got mutual funds that cover absolutely everything. The more specialized you get, the higher expense that you get. For example, the one that we just liquidated for one of my colleagues, the expense ratio is 0.9, okay, which is very high. An expense ratio of 1% is pretty high. And you can use the compounding calculator, and this is why I offer this link in the description of every single video I put on there to answer this very question, because it's that important. So if you go into the Trading Academy and you pull up the comparison of fees, you can compare what a 1% fee is compared to just investing in the benchmark like the S&P 500, which is VOO or SPY or IVV, whatever you want. Just same idea, different products, different brokers, okay? And you can actually run that scenario out over time, and you can answer that question for yourself and understanding the impact of that 1% management fee over the course of that time horizon. Now, to answer your question with regard to the performance, you have to be really, really careful to account for the cost basis. And it takes a scrutinizing eye to look at your statement or look at it on the computer and actually look at if it's a mutual fund that's been performing at a 10% clip for a long, long time. You really have to take into consideration the effect of that expense ratio over that same time period. 96% of money managers will fail to meet the benchmark, okay? And they never do it consistently. That's coming right from Jack Bogle. That's not mine. I borrowed it, okay? Lots of people borrow that statistic because over time, individual investors, unfortunately, are the guinea pigs to find this out, the canaries, okay? They're the ones that find this out in real time with real dollars, not monopoly money. Real dollars, okay? I was a victim of this. I was a victim of holding American funds with Edward Jones, okay? And I got my statement at the end of the year, and I was appalled to look at. Not only were my dollar cost average figures going into the account and yes, being invested, but they were taking 5.75% right off the top to even invest. Then we get to the mutual funds themselves, and they were of such high expense ratio within those funds that I went through an up year in the stock market. I think it was a 7% up year. I think it was under Barack Obama's administration. The S&P was up 7 or 8%. My mutual funds, my portfolio lost money, just by nature of the expense, okay? They failed to even meet the market in that portfolio. It was a real eye-opener for me. It was really kind of the beginning of the end for me as to why I thought that I needed to seek out something different Fortunately for me, the opportunity came to me, ironically, at about the same time that I was discovering how futile of a plan this was. The best thing that ever happened to me financially was the enlightening of understanding the impact of those fees. And I found out that if you could just put good quality assets, whether it be single stock or the ETF products that are conducive to most people's risk tolerance and strategy profile, that you could absolutely win over time just by nature of the account and the product that you chose. If you chose wisely, you would absolutely maximize that time frame that I talk about, and you would absolutely do so at the lowest level of risk. Okay. I know that was a little bit of a long-winded answer, but I would highly encourage you to seek out the education that I've sought out on my own to justify sitting in front of people for 3 years and trying till I'm blue in the face to convey this message. Okay. Maybe it's my problem. I don't know. Maybe I'm not very good at conveying it, but it's the truth. It's the truth. And more people need to be speaking up about it. I think I threw an invite in there. I'll go ahead and throw another one in there, but otherwise I'm actually enjoying myself. I miss doing these live. It's just when I do collaborations with other subscribers or channel creators, it changes the dynamic of the live stream. And I like to do this every now and then because, as you guys can tell, there's been a lot of pent up energy for me in making sure that I'm always driving that message toward those individual investors. I contributed a lump sum to my Roth IRA, and I'm scared to dump it all in because the stock market at once, due to the volatility in stocks, are at all-time highs. Well, do more. Do both. Contribute to a cash account and contribute what you feel comfortable with, whether it be $100 a month, $1,200 a year, whether it be $200 a month, $2,400 a year. Realize some of that contribution benefit that's yours back out of that. If you're not comfortable taking a huge amount of money, like a full funding amount, I've already funded my wife's account for this year, $6,000. I haven't invested 1 penny yet. No way. I'm heavy cash right now, guys. 41%, I guess, cash right now. So pretty heavy cash. I'm happy. Pretty heavy invested, pretty heavy cash, doing both, right? So figure out a way to win with your strategy in both up markets and down markets. That's the key. I've said this many, many times, and people are like, what? What did he just say? Well, if the market goes down, I'm going to lose. Nah, you got to change your philosophy, change your perspective. If you're going to be an investor, you better take the stock market for everything that it has to offer you, the goods and the bads. You can't come on the channel and say, whoopee-doo, I invested for the last 2 months and I'm up 6%. I'm awesome. It doesn't work that way, okay? And I hate to be blunt, but there's going to be a time when your fragile risk tolerance is tested, and that will be the true test of you as an investor. And those are the times when we lose most investors, when they're a little bit tested and they're like, oh my gosh, this volatility is crazy. I can't take it. If that's going to be you, try your best to forecast what it is going to be your reaction when volatility strikes up. That's why I offer that scary, scathing example of what would happen if you lost your entire portfolio. What would happen if it got cut in half? What would happen if you were down 20%? 20% is knocking on the door to a bear market, okay? That's not even a full-fledged recession. Could you imagine entering into a 6-month or a 1 year or a multi-year recession? Could you stomach that? Yeah, this is the real talk that I want to foster with regard to your investing, health, and fitness upstairs. Because if you're not right upstairs, you're not gonna make it to your end goal. You're not. Okay, it's not that difficult. Most people can get there, but it just takes a little bit of training and a little bit of conditioning and a little bit of help from folks like me who don't mind breaking down the information and saying this is what you've got to do. You've got to do it. All right. VYM underperformed the market. Quite different of a product than VOO, right? So, yes, it did. That's not really why you're looking to enter into a product like VYM. Like I said, I do own an index fund that tracks the S&P 500 in my other account. So to avoid redundancy, I go for a little bit more of a dividend heavy portfolio and then supplement my wife's portfolio with the S&P 500. So that's the bulk of my holding. All right. So good question. Has anybody compared using a dartboard to Jim Cramer's record? I haven't. I don't know. He's kind of gone a little bit more commercial, like most of them anyway. And he mentions self-directed investing, that I do give credit for, but it's almost like talking down to people, and I don't do that at all. I just look at self-directed investing as the only and best way to invest in the stock market, bar none, period. I don't care how persuasive you think you are with your ability to regurgitate the Wall Street Journal. I could care less. For me, at the end of the day, the numbers are what matters. And quite frankly, if I'm going to sit across from an audience on YouTube and say that my strategy is the best, which it is, it should reflect in your portfolios as well. I know it's already reflecting in mine. I know the power of it. It's all in the math, not the magic. Okay. Markets can remain stagnant for 20 plus years. Exactly. Come back to my point. The market is no place over the last couple years to think, because you've got a little bit of capital appreciation, to think that somehow you're going to be provided that level of high performance just because you're now involved in the stock market. Doesn't care. God, that tea is good. Holy smokes. You got to try some chai tea, guys. It's phenomenal. There it is. VYO is crap. VOO is better. That one fired me up. That's a good one. Different strokes for different folks, guys, right? VYM can absolutely get it done. So can VOO. They're both great products, actually. A little bit different strategy in what you're seeking. It's interesting, too, because a lot of people would poo-poo on the VYM program, but they would absolutely advocate for a program that holds a portfolio of $500,000 with 12 aggressive growth stocks in it. That may work for the individual, right? That does not work for the masses. And I know there's tons of people out there trying to replicate those portfolios with $1,000. Stupid. Sorry. Stupid. Okay. It's business, not personal. It's stupid. All right. The quicker you can figure it out and find the light and see the light, you'll be good to go. All right. Dividend growth investing is not about returns. It's about passive. That's correct, right? It's a different strategy. My point is very, very simple. If you're going to engage in a dividend growth investing strategy, you need to educate yourself up on that strategy and make sure you understand all of the ins and outs of that program, and not just do it because Joe Carlson does it. Okay. Don't just do it because a YouTube investor comes on and says, this is the greatest thing since sliced bread. This is lovely. You make dividends, it's free income. Because I tell you what, it's been so easy to justify, and a lot easier over the last couple years to poo-poo on a guy like me who is looking to say, maybe there's a little flip side of this coin, because we'll see how they react in a down market. Okay. And I think there's a difference too between what a lot of folks call dividend growth investing with companies like Johnson & Johnson and 3M. If you want to know what a true dividend growth investor looks like, look at Gen X Dividend Investors portfolio. All right. That to me is impressive. That's what it's about. But he didn't just take $1.5 million and just overnight, boom, there you go. I've got a perfect portfolio. It just doesn't work that way. All right. Dividend growth investors are usually looking for income, not capital appreciation that beats the market, right? So brings me back to my point. Is it conducive to new investors that have their first $500 looking to, engage in the stock market? What are their options? What are their options? Tell me. I want to be a dividend growth investor. I don't know the first freaking thing about it, but it sounds awesome. I've got a couple YouTube channels that I've found, and since I've found them, now I'm an expert, right? So should I buy 2 stocks? Guys, I get these questions all the time. Okay. I've saved up $5,000. What 3, 4, 10 stocks should I buy? I don't know. You want to talk about dartboard? good grief, good luck with that strategy. Okay. Now, the sheer truth of the matter is returns do matter. Okay. Returns matter. If over time your goal is to buy the best quality dividend stocks out there and hold them for the extreme long term, wonderful. But there's absolutely a difference between those companies like Johnson & Johnson and some of these dividend companies that I see these folks are pursuing. And I think it's risky. I think it's risky. That's my opinion. You don't tune in to me to get a gospel. I'm just telling you that's just what I think. It's risky. Okay. Any dividend over 5, 6, 7%, I would really, really question the integrity of that dividend and the ability to sustain that dividend over the long term, right? What I mean by that is great. A 10% dividend is lovely. To render that 10% dividend, you have to be in the stock 365 days to get that full benefit of taking your, let's say, $10,000 to make $1,000 to invest in a stock that renders a 10% dividend. Okay. For me, a 10,000, I'm up $1,000 right now in a month and a half in my aggressive growth portfolio. Okay. Nobody said, hey, good job on that, Ryan. No, I'd rather take my $10,000, dump it on one stock, right? And hope that at the end of the year, the end of that 365-day period, I make my $1,000, okay? With no discussion whatsoever whether or not that $1,000 of dividends is tax protected in a retirement account. Who the hell's asking that question? I am. Oh, at least if you're going to render those dividends, man, do it in a tax protected account for me, please. God, just do it. Okay. People are very, very, very intense about what they believe in. Okay. I acknowledge that. Okay. And I don't mean to hurt feelings. I'm more critical on my program than anybody else's. So don't feel bad. Okay. All righty. Here we go. VOO has been better. That is correct. My good friend, Jared Odell, my good friend, is the voice of reason. VOO is one of those, I think it's the only one of the Vanguard ETFs that I own in both spots. For you guys that know my YouTube earnings, I've yet to realize one dime. It buys me about a share or a half share, share and a half of the S&P 500 every month. So that's where my YouTube ad revenue earnings goes, to buy shares of VOO. And I own VB, which is the mix, a small cap, as well as the SPHD, which is an absolute dog, to be honest with you. Really great on paper. 50 of the highest dividend payers in the S&P 500. I'm up $18. It's just, I'm up 200 in VOO right now. Capital appreciation, I'm up 4 or 5%. The VB, I'm up very, very nicely, 3-4% in there as well. The SPHD, I'm up $20. So, and I've owned that holding the entire time that I've owned my first trade account, most of last year. So the capital appreciation in there, $20. Awesome. Prove my point yet? No, I guess not. We'll continue to do this. All right. I own more SPLV versus VOO. Awesome. Somebody says, I don't like Tesla. I don't like it now. Jesus, I can't win with Tesla. I'm up 100%. I bought the shares. I have 0.74 shares and I'm up like $258. If I sell it, I get whacked on the taxes. So what do you guys suggest I do? I don't know what to do other than to stay long on the company. That was my initial goal. And that's what I'll do. These folks that are holding Tesla right here, y'all are crazy. Y'all are about just as crazy as Bitcoin investors, man, honestly. So we'll see what happens. I wish you all the best. I don't care what the stock does, to be honest with you. I own such an anemic position. It was kind of a joke to throw in there. I tripped and I fell and I made money, whatever. Anyway, somebody says I agree. Nice. At least somebody agrees with me. I know I agree with me. That's good. All right. The value ETFs and dividend ETFs have underperformed. You're right. Absolutely. Yep. It's again, a little different strategy. It kind of speaks to the strategy of, I would implore you, right? If you're going to compare oranges to apples in that manner, take a look at your own dividend portfolio and tell me if you've outperformed the market. Okay. The answer is no. Okay. All right. So if your goal is outperformance or to match the market, okay, that should be the key because, I'm not one of those guys. I actually did beat the market last year. What I had to do it was a lot of swing trading in the account, and it wasn't worth it. So if I was another personality, I'd come onto YouTube and be like, I'm the god of stock investing. I've beat the market. Come follow me, buy my course. No, I don't do that. Why? Because I have integrity. I have integrity coming out my ears. I offer this information free of charge. Deploy as you will. Okay. I'm up 2,700 in mutual funds, VSTAX, VIGAX, VWIGX in my brokerage account. Then I'm no longer going to contribute to these positions. Let them grow, Steve. Those are great funds. Okay. It's really difficult for new investors to get along that suite of products that you've just named. Those are really good. And there's a lot of good mutual funds out there. There's mutual funds that do beat the market for a few years. My question is, again, do you want to expose your money to that risk along your time horizon, man? That's yours. Treat it well. Treat it well, right? Maximum amount of potential, minimum amount of risk. Maximum potential, minimum risk. Does the mutual fund fall into that for you? If it does, great. If not, readjust. Or keep the positions. You're up $2,700. You're playing with house money, right? Maybe you want to deploy a little different strategy, right? Maybe you want to do more of a passive program in there. You can do that, okay? Really good stuff. Thank you, Steve, for offering that. I appreciate it. I'm in Tesla at 249. You're lucky. So Alan Kane throws it up, and that's awesome. In all seriousness, see, I can kind of flip, and I just feel like there is a time to focus on the serious aspect of what you're getting from the YouTube opportunity, because you have to question everything, even the stuff I say. Question it for your own good. Okay. I question my program. Am I doing the right thing? And that's the deliberation that you'll learn to live with as an investor. Okay. You need to ask yourself, I've made mistakes, right? But isn't it better being an investor than being a non-investor? I think Jared Odell and some of these folks, Steve, would say, yeah, it's absolutely worth it. How would I have been able to get this $2,700 of white meat that I'm working with, a house money here, had I not invested, right? So the stock market opportunity can be extremely lucrative. It's just money makes a man funny sometimes. Don't mean to offend the ladies in the community as well, but it can be very tempting to fall off kilter and pursue pipe dreams when in fact those pipe dreams, your percentage of success decreases so far that you might as well not touch them. All right. And, if you're coming in here to get direct comms with me, the Independent Investor channel, I typically revolve around a lot of different aspects of investing and not just come on and say, I've got a big ass portfolio, follow me. Okay. I don't do that. Like I said at the top of the live stream, I could care less about the size of mine portfolio or your YouTube channel. I care way more about the Jared Odells in this community who's been with me for years. That's what I care about. Conversely, I care about the Gen X dividend investors who don't need to do YouTube, who do it and do it at such a high quality, right? Doesn't have to do it, but seems to have the mental game right. I'll go out on a limb. I don't know who this person is, to be honest with you. I don't know. It's omnipresent. It'll be fun to meet someday. Hopefully I get to. If not, no big deal. It was a great social experiment and being part of my community as I'm part of his. And that's great. But I'd love to meet some of these cats someday. Absolutely. So it kind of lets you know along the spectrum, I've got some of these legacy investors that have been with the channel for a long, long time. And they're like, freaking right, Ryan, I get it. And that's not, you're speaking English. You're not speaking a language I don't understand. You've said it many, many times and 100 times over in different ways to make sure that the message is conveyed, right? Making sure that people really, really get it, right? Because I know that if you're picking up on the right stuff, you're going to be like Steve, and you're going to be one of those folks that can duplicate the level of success and render some success in the market. There's a lot of success there to be rendered. Just don't go off kiltered and get crazy on me. All right. All right. All right. What? No entertainment. Then why be here? He's picking fun. Retire with options is picking at me. You know what's entertaining to me? Money. What's entertaining to me, I mean, I get a sick return on value of doing the independent investor channel because I love helping people. And it makes me fired up to know that maybe some of the messages will in fact misguide, especially new investors. And they just need to make sure that they're being careful. Okay. And I would contend that everybody can start slow, take a little dab of passive approach, and get themselves used to watching their money fluctuate. Super important. Please don't scare me on Valentine's Day. I know I was pretty fired up at the beginning there. You're right. I've calmed down since, and I'm really happy that I'm not coughing into my microphone all live streams. So let's be thankful. Let's give thanks together. Very cool. Nice, Alan. Hold on. We've been going about 1:21, man. I cannot believe nobody jumped into this live stream. I'm delivering to a huge audience, worldwide audience, and nobody jumped in during the prime time. They let me take the prime first hour and a half of the live stream, guys. I can divert back to the old way of me getting on here for 2 hours to rant. I just think it's a little bit more of a break for me if we do run the collaborations, but the verdict is still out, certainly. If you'd prefer that, we can do that too. But I'll continue to offer that opportunity, throwing the invitation in there. You guys can come rap with me before the live stream or after if you'd like. Okay. All right, we'll throw some of these other ones up here. Popular delusions and madness of crowds, McKay wrote about crazy behavior. Awesome. I love it. Steve, got no reason to sell. No reason to sell. Nope, no reason to sell. Hold on to them. I would do both. If you like the funds, and you continue to fund them, it's awesome. All kinds of different options. Steve's being like, hey, man, come on. The idea there is the focus on the 7 to 10% rate of return year over year with the 3% dividend to boot. I'm not really sure how that's crap. But anyway, if you put that into the compounding calculator, that'll render you over 40 years, the 7 figures. And you don't have to be wealthy to walk that path. You just have to have some imagination and wherewithal to walk the road that the Independent Investor channel has paved for you. Yeah, I've paved it for you. I provide all those resources in the videos. And for the few people that have gone on there and looked, they'll understand absolutely what I mean. They'll be like, dang, I can do this. Over the course of my life, I'll only have contributed 125,000, but now it's worth 1.345 million. Amazing. Amazing how that works. You're the best, Ryan. No, I'm not. You're a genius, Ryan. No, you're not. Just a regular guy. Don't really care too much about being a social media star either. All right. Just an investor trying to share a story. That's all. All right. We are making a difference. No doubt about it. What percent is that dollar amount? Don't matter much as everyone has different portfolio sizes, but percentages show volatility and speed. Certainly. I think to my point, aligning your strategy with the products. I know you're a little bit more advanced of an investor, Brent, right? So always making sure that I had the question today when I was talking about my friend who was asking about some investing potential today. He's like, can I just own VOO? And it was like, yeah, absolutely. You don't have to have 30, 40, 50 holdings in your portfolio unless that's what you want. Okay. And, you could spend your whole life trying to outthink the system, and you might have just been better off just investing in the one Because at the end of the day, if you're getting underperformance out of 30 or 40 holdings, as opposed to matching the market year in and year out, down years, up years, doesn't matter, right? You're matching the market. How are those two going to perform when put side to side over the course of a lifetime, right? Maximize potential, minimize risk. The time horizon is yours. Do with it what you will, okay? I don't hear anybody else talking like this when they're talking investing on YouTube, so I won't apologize for demonstrating the information or conveying the message in that way, okay? It's just my way. All right. All right. It says, I wish the market dropped 40 so I could buy more on sale. It's all so expensive right now. It's probably one of the smartest comments that I've thrown up on the live stream, actually. I agree with all of that. I'm not really sure if we're going to get a 40% downturn. One thing that I would add to this, just to strengthen that comment, is to say that the economy right now is strong. It's strong. There's a lot of things going on right here. Yield curve is flattening just a touch. We are at max unemployment. Okay, tell me the things, the factors or triggers that may trigger a recession. Look back in history. That's two of them right there. Inverted yield curve, max unemployment. Okay, and I think record low interest rates is the other one, but I may be mistaken on that. I don't want to misspeak in front of my crew. But yeah, it's a killer comment. I just, again, 40%, that'd be pretty brutal. If I got a 40% downturn as of Monday, I would probably come onto YouTube and start screaming and yelling enjoy, because it would be the greatest short of the stock market that's ever been registered in the history of the stock market, because I am pretty heavy cash. It just doesn't work that way. The exposure that I have right now to cash, I'm happy with. The exposure that I have to the stock market, I'm happy with, right? If you gave me Gen X dividend investors portfolio, I would be putting chunks into the Bank of America at 249,999. If anybody can tell me why, I give you extra credit. But I wouldn't have that much exposure to the market. That's just me. He would disagree with that, but I don't know the totality of that situation. But that would just be my opinion, right? Pretty high exposure rate to the market, depending on other factors, right? I would have at least a couple, maybe three, maybe three FDIC insured accounts, baby. You betcha. Put that stuff away and live life. You're good to go. But then again, I'm sure he's enjoying the dividend income that portfolio drips. So absolutely. A lot of fun. All right, Steve T, compared to other ETFs that follow the market. Yes. You guys are having a robust conversation amongst you. I love it. It's great. That's what I'm here to do. Facilitate the conversation. I only have a half hour left on the quickest 2 hours of my week. The 2-hour live stream on Friday. I got to dig deep for the deals in a market like this. You do. You have to dig deep. But I do agree with the overvaluation that Wandering Soul is talking about. It's overvalued. Okay. Calm down. You can read all the articles you want about all the justification for this garbage. Wait till the bears come out when talk starts to change. Sentiment is positive right now. Okay. Investor sentiment is at an all-time high. We did have record inflows into bond funds this week, guys. You do know that. That's fairly telling. Got a lot of baby boomers that are getting to that retirement age here with the stock market at an all-time high. Where do you think they're going? Do you think that they're continuing to hope that their $1 or $2 or $3 or $5 million portfolios are going to continue to go up every year like it is? I wouldn't. If I was 55, 60, 65, 70, and I was sitting on that type of capital, I'd be like, I'm a freaking winner. Yay. Cha-ching. That's just me. All right. All right. Ryan Spicy. I am spicy. Nothing to drink either. Must have had Mexican food. Gosh, thank you, Jamie. I really appreciate that. You know, Jamie's always the jokester of the group. Every single party needs a Jamie. Every party, no doubt about it. I think Jamie's like the life of the party for sure. So he's welcome at my barbecues anytime, man. Jamie's another one of those guys I'd like to meet someday in person for sure. It's great to see you, man. Thanks for coming on, help us support the message for sure. Yes, I am spicy and I'm a little bit under the weather. I can hardly see, but I'm doing the live stream nonetheless for the crew. I think maybe if a new investor made their way to the channel tonight, they may have got something special. I don't know because I'm selling out tonight. All right. Here we go. A lot of people the market after 29 crash bought cheap and a lot. Absolutely. It's been 49 crashes, corrections, etc. They've all been buying opportunities. The idea is to align what I said about the strategic buying option and align the good account that I talk about. There's not 100 different accounts. There's one that I contend that is underutilized and under talked about, which is the Roth IRA account. So take the account, fund it up where and when you can, fund these, fund them when they're down, and you're good to go. Live to fight another day. Learn to play guitar. I don't know. Read a book. Do something productive with your time. Do what I did tonight. I went and worked out hard. You should hit the gym with me. You guys think I'm aggressive about investing? You should see me in the weight room. Yeah, I'm strong. What can I say? Keep it that way. All right. Here we go. You can't compare VYM, VO, or VTI. That is an unfair comparison. It is. It's comparing apples and oranges, two different strategies. That way, if you put one new investor and they say, look, I'd like a little bit more capital appreciation, the VOO is your ticket, right? If I want to be a dividend investor, that's where it gets interesting. Because again, I come back to you take 100 investors and you say, here you go, 100 investors. Here's $10,000. Build a dividend portfolio for me. Okay. You're going to have 100 different results. You're going to have 100 different renderings. You're going to have 100 different levels of exposure. Whereas the one person that bought the appreciation has one result. They met the market. One result. Do you want to be the one of 100 people who get X result based on your vast, extensive knowledge about stock picking? Or do you just want to just maximize your potential, minimize your risk? Your time horizon, remember, you can't get it back. Okay? Make the most of it. Okay? Pull a little Quigley down under it tonight, man. Tom Selleck. You guys remember that movie? Yeah, that's awesome. I am spicy tonight. This is great. Who is it, Ryan? Spill the beans. Who's what? My special guest? I don't schedule a special guest. I basically put an empty chair next to me and they can come and fill it as they please. I'd love to have you on the channel. Since I've known you now for 2 or 3 years, you've been a featured channel since the Independent Investor channel was in its infancy. Well, we still are, but you're welcome to kick on here one of these live streams. Don't kick on now. I'd like to give you a featured block. But when you have a free moment, Brent, you got to kick on, man, and help rap with me a little bit. Most of these channel creators have already done so, except for the illusion of what we know as Gen X dividend investor. So, but Hidden Freedom Investing is in the group tonight. Dave is awesome. So great to have. And then right below, I've got South Bay Investor, legit, and JMac Investing as well. He was a friend of mine for sure. I hope that correspondence helped you, Jason. I just kind of put an all stop and had to send you that email. Hopefully that helped you, man. I'm interested to know what came of it. But it's great to see you, my friend. Awesome. Thanks for popping in on a Friday. We're going to wrap it up pretty quick, but I'm going to try to get through as many of these comments as I can. On September 10th, 2001, how many of you felt there was no risk in the market? Now, well said, man. Well said. Yeah, the world's a crazy place, man. I think this pandemic that we're going through currently is worse than what we think. I've been forwarded some correspondence that is alarming. Not to scare anybody, but it's worth paying attention to. The market seemingly is brushing it off, I believe, because the United States has done a pretty good job of keeping the cases to 20. But the sheer magnitude and potential of this is something to pay attention to. Yep. Yep. Absolutely. I got my good friend here, Gen X dividend investor who's made their way in, has just rounded out their portfolio. Again, highly endorse Gen X dividend investor, #1 channel on YouTube. Again, I'll say it again. I say it every week. Very, very simple. It's great to have this community working together, sharing different philosophies as well. South Bay investor, I will still in my dad's. That's awesome. Right on, man. That's a hell of a comment I just put up there. Hope there's no kids that make their way to the live stream. I'm just clicking through all of them. VYM can produce great yield on cost over time since the shares appreciate well over time. That's the same. That's the same justification that dividend growth investors give, and it's a valid one. It is. It is absolutely your goal. Who is it appropriate for? Well, if I was sitting on 750, a mil and a half, a mil, 2 mil, right? You bet I could build the most killer dividend portfolio you could ever see, right? I'm just not so certain if the dividend growth philosophy is someone that is good for somebody that has 500 to 1,000 starting capital and not a lot of funding capital on top of that. In that particular case, it's not conducive to worrying about the cost basis on a couple of dividend stocks that you run the risk of picking the wrong one or having severe underperformance in, as opposed to the alternate that I've already mentioned 100 times tonight, and that is going after a little bit more capital appreciation, that of which can be rendered in the S&P 500 just as easy as anywhere. There's probably other avenues to pursue, absolutely, but that's typically where I start and stop with new investors. Get up to at least that first 10, 20, 25,000 bucks. That'll give you a good amount of time with time in the market. And that way you can reevaluate at that time. God dang, guys, give yourself a freaking fighting chance. All right. Don't sit there and spend the first 10, 20 years of your investing career trying to build a dividend portfolio up to $100,000 when it could have been at $400,000 over that same time period. All right. Get with the program, guys. It's all about money. Okay. It's all about money. And the decisions that you can make really can make a huge, huge difference over the long term. All right. I'll throw this in here in the personal finance channel. Awesome. Some new channels popping up. I saw the personal finance channel pop in here last week. Really appreciate your time. Absolutely. I do my very best in getting to all these channels. But good luck with your channel. And I've obviously some of these guys will kick over and help support you, throw you in their subscription list. And it's awesome. Thanks for your time making your way on here. All right, I'm cruising through. I'm about halfway. I could go for another 2 hours on the rest of these comments, but that's all right. Here we go. You'll have to pay taxes down the line anyway. No. I'm not sure if that's to me. Yes, in my 3 taxables, I have 4 taxable accounts, 1 joint brokerage and 3 taxables, all of which are taxable accounts, and 2 Roth IRAs. So in the Roths, no, I can do whatever I want. I can skip and jump up and down 3 times. If that renders me a dividend or a capital appreciation, it's free of charge, good to go. You can do what you want, how you want, when you want under a Roth IRA. Anything taxable, you got to be very, very careful. You'd be subject to short-term capital gains, anything within 365 days, anything beyond 365 days, going to render yourself, put yourself subject to long-term capital gains in that. So, all right. Let's see. So there's Jamie talking like a cowboy. That's awesome. Howdy, Gen X. Good to see y'all. Yep, he doesn't look at all like a cowboy. He probably does not own a pair of cowboy boots, scotch, and a smoke before the 3-day weekend. I love it. Good job, guys. You're being healthy and being good investors. I love it. Here I am talking about going to the gym at 42. Must factor in inflation and tax. That's a really, really good point. Tax is the big one. Inflation is never talked about enough. Probably one of the main, if not one of the top tier reasons to invest in the first place is the effect of inflation over time, knowing that we could take advantage of this compounding effect going forward. But the monies that are rendered 20, 30, 40 years down the line are, if trends stay the same, will be worth less, right? So it's hard to imagine just initiating a savings program with the effect of inflation, because $1 million 20, 30, 40 years from now is not going to be the same $1 million that it is now. Okay. Really good stuff. All right. There's Treatum Finance. He's still talking. He's still talking. That's awesome. Just accept it. Yep. That's so that I did videos on this too, man. Just accept it and whatnot, and just like talking about like definitives. Like it's crazy. And I know best and all this. VOO and VIG are the best. Awesome. Love it. All right. Alan King, I caught something too. Just got back from Hong Kong and ordered Chinese food. Nice. My wife loves me. Jamie, thank you. Awesome, man. Happy Valentine's to you. She just bought me 500,000 in life insurance policy and a vacation to China. Yep, there's the jokester. He's coming out again, man. He's having a good time. That's awesome. All right, guys, we got about 20 minutes in the stream. I'm going to finish strong if I can. Stay in the live stream. This one turned out to be the Independent Investor Show tonight, which is totally fine. If you are one of the 90 patrons of the live stream, please do me a favor and hit the, please smash, demolish the like button. I'm just kidding. Actually, if you don't want to hit the like button, don't. How about that? Let's take a different approach to this. Let's use reverse psychology. Okay. As a matter of fact, if you're in the group here, please leave the group and don't hit the like button or the subscribe button at all to support the channel for all this terrible information that you've got tonight. Reverse psychology. All right. I'm allergic to bees and my wife wants to go on a picnic. Ew. Ouch, Alan. Good grief, man. Don't worry, at Independent, I love you. Well, I don't know you. I'm a lovable fella. Actually, I'm not. I'm actually more of a hateable fella, to be honest with you, because I'm so freaking blunt. But I hope you don't take this the wrong way. I only love 3 people in this world. There's a few more in the extended family that I do love, but that's about it. All right. Most people irritate me, to be honest with you. All right. Hey, hello from California. That's the South Bay investor. Rock on, man. Very cool. Love it. All right. BYM is not crap. There, tell him. KG Ajum. It looks like maybe I have like a 15-year-old subscriber to the Independent Investor channel. Awesome. Congratulations. You've just found like the golden ticket, right? If you've ever seen Charlie and the Chocolate Factory. Yeah. Yeah. You just found the golden ticket. So congratulations. Deploy it you will. Wait till you're 18, please. Good stuff. Yuck, fruitcake. Absolutely. Roth IRA, number 1. Absolutely. If you value tax protection and wealth preservation over the long term. All right. Trying to rip through every single one of these. If I can get to the end of these comments by the end of this will be awesome. HA is a hell of an investment vehicle. Rock on. Roth IRA is a great and probably number 1, 2. Yeah, I already got to that. Good stuff. So I'll definitely offer. I don't know why Ernest doesn't ever pop on here with me. I think that'd be pretty awesome. I'd be as stoked to see Ernest pop in here in my collaboration than I was to see Jared Odell a couple weeks ago, because that was pretty freaking awesome. Pretty awesome. I still remember that. That was a lot of fun, man. It's nice to know that you're making an impact, even if it is with 2 people. No, I'm just kidding. Just kidding. I know we're impacting more than that. I know. I get validation come through the channel all the time. We already covered that, and we got a high Ryan Blitz. So this is awesome. I read a comment tonight, and I was like, I always feel like, wow, like it's just amazing, these comments that I get. It's humbling. I appreciate it. Thank you very much. I won't rest, honestly, until I am satisfied that my mission, I do call it that. It really is. I think the system is designed to hold people down. Yeah. Yeah. And so that's why I'm so intense on people following the program that I insist is the one that is conducive to the majority of people initiating and succeeding at. And I know people won't hear a word of what I just said, but I know that if I can convey the information in a different way that helps more people understand it, maximize potential, minimize risk. The time frame is yours, right? Don't screw it up. That's investing in a nutshell right there. Okay. But I'm very humbled at those comments, and thank you so much. It really helps. Motivation comes ebbs and flows for me on the Independent Investor channel. I'm not motivated all the time to make YouTube videos. It's somewhat shallow of an activity. Quite frankly, this activity right here, I love. I love the live stream. I absolutely love it. So next week, I would love to have somebody that loves it just as much as me come on and enjoy it with me. Otherwise, we'll continue to deliver the message on my own. I've already answered, Robert's question. So now I'm back down, caught up anyway. So pretty cool. God bless Canada. Y'all Americans got some serious problems, right? Yeah, it's great. I typically don't spend any of my time finger pointing ever. I don't get it. I don't get it, but that's awesome. Thank you. I didn't know I was going to come on my own live stream and be judged. That's awesome. So I appreciate that. Lovely. I've got pretty thick skin though, and some hella chai tea right now. How was Ryan sick with this much fire in him tonight? Yeah. Did you ever see that game that Jordan put all that? Yeah, that's motivating stuff right there, man. Remember when he had the flu? That game was awesome. Holy smokes, man. You can dig deep. I'm not going to miss a live stream for this. No way. That is not cool. There's a takeaway for all you new investors. Absolutely. You got full disclosure. I'm almost to the bottom of this thread, guys. So if I missed any of the channel creators, which I don't think that I did, I got most everybody that made their way in tonight. I thank you for your time. I really appreciate it. I really try to do the best I can in providing that transparency. Got an interesting question here. Ryan, are you holding any gold and silver? I don't. I think there's a inherent responsibility when you seek out or pursue this option. 5% rule is a good rule of thumb for any investors that are interested in buying gold and silver. I do not consider gold and silver an investment. I've said this many, many times. I consider it a hedge, meaning that I would buy gold and silver indefinitely. I wouldn't buy it with the intent of ever selling it. I would buy it with the intent of hoarding a small amount. If the amount went that far over 5%, I would sell back to 5. If it went down to 4%, you could buy more. And that would be the rule of thumb, working around kind of a core position at 5%. That also is not mine. It's Kevin O'Leary's. I got that idea, thought it made real good sense. But as far as like, some folks will take their entire portfolio and swap it over into a precious metals IRA. That to me seems crazy. No, thank you. I don't. I like the liquidity of money. I like the ability to grow wealth and grow it tax free. I may be accumulating coin and bullion and junk silver later on in life. I like it in a lot of different denominations. Hell, I like copper, to be honest with you. And I'll be accumulating those metals maybe later on in life to pass to my heirs. But for right now, don't really see a whole lot of point with it because of the responsibility to safeguard precious metals in the proper way. And that's a whole nother discussion for a whole nother day on what you think proper safeguarding of precious metals is. All right. So, all right. Good stuff. All right. Treatum Finance made it fun tonight. Absolutely. I appreciate it. Tesla's good, but just overvalued. Right. It's insanely overvalued. Right on. Oh, hey, here just to EXP. Good. Yep. No, I keep the hate to a minimum in here. I gave my first boot last week. That was fun. Anyway, don't have any place for it. I use them on finance. I put $10 a day in Tesla. We already reviewed that. That was a good one. Cash on the side for a rainy day. That's my philosophy now. Sacrifice and retire gets me to the 1%. Yep, good. Just reviewing the last few comments in the thread, guys, and then I'll give my closing remarks, which you're probably not going to want to miss tonight. What am I going to say? I have no idea. What am I going to say? Is it time to sell some profit stocks and make some profits booking and wait for a bear market? Man, I tell you, I've never been asked that question before. It's a good one. It's the $1 million question. I do goes up and down market. So it's a good question. I get this all the time. I really do. It depends. It depends. I would say do both, depending on what your position is. I mean, you could be at a $10,000 position. Hit me up with this question. If you had a 40% downturn in the market, you're going to be at $6,000. You look young by looking at your thumbnail. Why invest? What are you looking to do? Are you looking to double up the position? If you take a little profit now, you start to really get into a fool's game if you're looking at doing that. Now, if the $10,000 is all the money that you have, and you're wondering about the level of exposure, I wouldn't sell to take profits. I would sell to delever some risk. Okay. And if you got over involved in the market when you first started investing, certainly there's some work there to be done, right? But I get this question all the time. I wish I would have got this question at the top of the live stream, because I can really go off on this topic, because it's super important. Because I've thought this as well, and a lot of new investors think the same way. Should I take profit now? What's going on, Ryan? And I always hesitate. The smart answer and the short answer is no. That's the short answer. But there's more to it. See, I don't know what your initial goal was for the money. I don't know if you over leveraged yourself to the stock market, and now here we are at this all-time high, and you've racked up a little bit of debt. You've got $20 in your savings account, right? That's going to be awful impactful for you to take a 40% haircut on that money. If you're looking at $100,000, okay, money is relative to me. I can make it fit to any scenario. The idea is that I don't know what your situation is. So if you're looking at six figures here, I'm looking at multiple six figures, and I've just declared to you guys with full transparency what I've done. I've put some money to cash right here. It could be the biggest mistake of my life, according to everybody else. For me, it makes perfect sense. So I'm good with it. I really am. I'm still holding my core positions, and I'm building nice starting positions in VYM and VOO and the other ETFs that I've disclosed to you. But I'm not going whole hog either. I have cash ready to deploy. I could just as easily take a $50,000 position in both. Am I going to? No, I'm not. I'm taking starting positions, and I'm going to fund them strategically up over time. If I get that big hiccup in the stock market, I'll take advantage. The idea is that I'm ready and able to react to anything that the stock market throws at me within reason, because I'm constantly looking for that backup plan, constantly looking at that backup plan. Now, if 6 months from now Bernie Sanders gets elected, okay, stock market gets volatile, hicks up, and you look back at this time, February 14th, and you remember that it was Valentine's Day, and Ryan was trying to provide you a lot of love, and you were like, man, I wish I would have done that. I wish I would have done that. I wish I would have done that. It's too late, okay? The time to make those moves are now, but it has to be with relative perspective. If you're at $10,000, that's really not a whole lot of money to be finagling with if you're young and you have a long-term horizon, right? So the answer is no. Okay. If you're at $150,000 and you want to take a little bit off the table, no problem. I want to throw this up here. Profit is fine. Waiting is hard to get right consistently. That's the absolute truth. I have a different way of putting it than Gen X. It's the hardest, easiest thing you can possibly do. Whatever strategy you deploy, right, you really, really need to think about buying and holding for the long term. You really, really do. And the idea is no matter what amount you determine is appropriate for you and your risk profile, make sure that that is aligned with your risk tolerance. Super important. Okay. If your net worth, if you've got $100,000, for example, and you look at that 100 grand and you come on the independent investor channel and you're like, I'm dumb. I don't know anything. I don't know what to do. Ryan, help me. Right. I don't know. I would throw the question back to you. What makes sense to you? What do you want to do? What do you want to do? You want to max fund a Roth IRA? That's 6 grand. There it is. Max fund. Okay. You've got $94,000 left. Okay. You want to take the other 14,000 and start a taxable account with it? Or would you rather put $80,000 away in a savings account? Would you rather start a dividend portfolio, bond portfolio, that type of thing, and you start piecing up the money? And that's what makes sense to me. Now, the reason why I start with that top end 20% out of that 100 grand, you notice how I didn't just say, yeah, invest the whole $100,000, right? I do that because my scale would adjust. If we weren't at an all-time high, I would say, well, right now I think we're in a bear market. Maybe it's prudent if you want to become an investor to take 25,000, 35, 40, maybe even half of that money, invest it in a good index fund or ETF within a Roth IRA. Take half of the money and put it into a savings account for your sleep easy money, right? If we're in a prolonged recession, my perspective on that will change. It will change. But why would I talk about investing full on right now when the market is telling you what it's telling you? We've been on a 12-year bull market. Okay. Now is really not the time to be going full throttle and investing and eating pinto beans out of a can. Okay. Even though I like sardines, you might want to just kind of tailor back a little bit on that strategy right now and give yourself a fighting chance to average down a little bit, have some sleep easy money, and don't ask yourself, gosh, what if? Like, what was I thinking? If 6 months from now you look back and the market does end up going down, let's say 20%, and you look back and say, God, man, I had it. Like, what was I thinking? I wanted to invest my first $10,000 and I took the whole wad and I dumped it on the stock market. I didn't want to do it, but everybody told me how important it was to invest in this stupid VOO thing, right? Everybody told me how important it was to buy these 5 stocks to buy and hold forever. Or everybody told me how important it was to seek out a higher than average dividend. Why? Now my portfolio is worth $7, $6, maybe even $5,000. Now what am I doing? I'm considering cashing out now and never investing again. Instead of just taking that $10,000 and saying, you know what? Interesting. Market's at an all-time high. I'm going to take this 20% of this. I'm going to take 8,000 of white meat, put it away, and I'm going to scale this first starting position into a Roth IRA, $2,000 into the market. Okay. I'm going to have this $8,000 as dry powder, sleep easy money, etc. When the market does end up creeping down, or you can max fund the account, right? Take 60% of it and max fund the account. And then you've got that dry powder there ready to go. 10 shares of the S&P 500 right now is $3,000. That's what it costs. Okay. Get that $3,000 in there and keep half on the side within the Roth IRA. That's another option for you. Keep the remaining $4,000 out. So give you kind of an insight. I typically try to put the hinge on my head and show you my brain during these live streams and give you an idea of how I think about money. It's relative. It's the same deliberation that you go through, whether or not you're talking about 10, 100, a million, or a multi-million-dollar portfolio. It's not rocket science. It's the same deliberation. How much risk is prudent to be put to the market right here in alignment with your risk tolerance? And that right there is individual to the investor. Okay. $10,000 fully invested right here in this market could make sense for the right investor. Taking $10,000 and investing it full for a full-on first investor with no experience who's scared to death of themselves, probably not the best idea. All right. Guys, we hit on a ton of topics tonight, man. We're going on about 2 hours. Honestly, just thank you from the bottom of my heart in all sincerity. The community means a lot. What means even more to me is the message that you get from and the ability to take the message and deploy it for real, tangible results in your own personal lives. I'll continue to roll out the collaborations from week to week. Certainly take advantage if you feel like you're a little bit tempted to waltz on the Independent Investor channel, not only during the live stream, but prior to. Feel free to do it. Okay. It might be worth it for you to come on, as some of the folks have already done so. Steve has done it. Most of the channel creators have taken the opportunity to come on and share the message. I do get fairly good exposure from the live streams. So that's a little bit of give back to the community, and especially the channel creators who are also looking to grow their message as well. So with that, I will sign off. We just clicked over the 2-hour mark. It's the fastest 2 hours of the week. Oh, darn it. I got to wait another week until I can come on and hang out with you fine people. Happy Valentine's to you guys. We'll see you next week. Take it easy.